Last year I was an attendee at this conference, and I'm very glad to have been given the opportunity to give you a presentation about how we in Lundbeck think about FX risks and how to manage these risks. I have built my presentation around the fact that Lundbeck over the past years have gone from primarily being a European company to a global company, which have increased the FX exposure. I will also come into how we from Treasury are trying to create value in this new situation. Before we come into the agenda, I promised my investor relation colleagues to show you a disclaimer. So basically, don't trust anything I say. I will start with a brief introduction to Lundbeck. I will then come into how we from Treasury try to create value in this new situation, coming into our hedging strategy, what our FX exposure looks like, and also how we determine our hedge ratios and how that process have changed over the past years. I will then give you two practical examples of how we have been impacted by the increased FX exposure and how we are trying to create value in this situation. But first, Lundbeck. Lundbeck is a specialized pharmaceutical company engaged in discovering, developing, and commercializing new and innovative treatments for brain disease. We were founded in 1915, and we actually last Friday had our 100-year celebration, which I'm still recovering from. We are about 5,000 employees, and we last year had a turnover of 13.5 billion Danish kroner, which is equivalent to approximately 1.8 billion euro. We are owned to 70% by the Lundbeck Foundation, and the remaining 30% is held on the Copenhagen Stock Exchange. We are the second largest pharmaceutical company in Scandinavia and the 42nd largest in the world. I've also brought a slide showing our main products and what diseases they treat. First of all, we have a product called Celincro, treating alcohol dependency. We have Ebixa, treating Alzheimer's. We have Brintellix, treating depression. We have Sabril, treating epilepsy. And Senazine, treating Huntington's disease. And finally, Asilet, treating Parkinson's disease. I've also brought a short video that was made for our 100-year celebration, which I believe quite good illustrates the complexity in what we are trying to achieve in Lundbeck.
Imagine having to find the one defective light bulb. Every minute of every day, the billions of cells in our brains send and receive signals that influence everything from the memories we form to the emotions we feel. The human brain is fascinating. By studying the brain, Lundbeck hopes to better understand the underlying mechanisms of brain disease. Our fascination started almost a century ago. As one of the only pharmaceutical companies in the world solely dedicated and entirely focused on treatments for brain disease, we have developed and marketed leading medicines for alcohol dependence, depression and anxiety, psychosis, epilepsy and Huntington's, Alzheimer's, and Parkinson's diseases. Throughout the years, millions of people have been treated with our therapies. It is complex and challenging to develop improved treatments for brain disease. It can seem like finding that one defective bulb among millions of lights. But we keep our focus. There is still so much we need to achieve in the next 100 years to ensure a better life for people living with brain disease.
As you can see on this world map, where the dark green represents the 57 countries where we are present, it includes some exotic currencies, such as in Asia and South America, which we need to manage from Treasury. We are present in all continents over the world except for Antarctica. As I described in the beginning, Lundbeck has over the past years made quite a significant regional diversification. And as you can see here, in 2010 we had 54% of our sales in Europe, and as far as we have come this year, it's down to 28% of sales in Europe, which have also implied that our FX exposure have increased. With this new situation, with an increased FX exposure, it has meant that we from Treasury have been given the opportunity to show that we really create value for the company. And the way that we are trying to create value is through creating transparency to enable robust decisions. And the way we try to do that is by creating predictable results and cash flows, by being a trustworthy partner towards our stakeholders, and through risk mitigation. But to do this in practice, we need to know what the company wants, and we need to know what mandates we have within Treasury. And to do this, we need to have a hedging strategy. And when we think about hedging strategies, we think about risks. And I try to illustrate the risks that we are looking at by this table, where we have the first element being the risk attitude, going from being risk averse to being a risk lover. The second parameter is the risk profile, going from wanting to taking no risk to taking high risk, while the third parameter is the consideration between risk and return. When you have decided which risks you want to accept, you get your objective and you get your strategy. Within Lundbeck, we believe that Treasury's job is to minimize or even if possible eliminate the FX exposure. We do, however, believe that we have a certain expertise within this area, which we would like to utilize the best possible way. We have therefore decided that we should be in the risk-neutral area. And with a risk-neutral attitude, it implies that we create a small maneuver room for us in Treasury to deal within. And the way that we are trying to utilize our expertise is through having the mandate to hedge between 0 and 150% of the annual exposure. We also have the mandate to choose the hedge duration between 12 and 24 months. The hedging strategy is also part of our treasury policy that is approved once a year by the board of directors. So now we know our hedging strategy and we know what mandates we have, but we of course need to know what we are hedging. And I tried to illustrate just roughly the net FX exposure for Lundbeck. And as you can see, we have about 20 to 25 currencies where we have a net exposure amounting to equivalent approximately 6 billion Danish kroner. I've also tried to illustrate how we are managing our FX exposure. And as you can see on this picture, all of our subsidiaries only have intercompany transactions with the parent company called H.L.U., which is short for H.Lundbeck. All of these transactions are also in the local currency of the subsidiary, meaning that the full FX risk is centralized to H.L.U. This also makes it more easy from a compliance perspective, such as email reporting, as we do not have any intercompany FX deals. One enabler to have this centralized structure is to have a centralized purchase department, which means that all our products are purchased to H.L.U., who then sells it further on to the subsidiaries. Meaning that no subsidiaries have intercompany transactions with each other. We are currently hedging our net cash flow. We are, however, considering to change this to instead hedge our EBITDA, in order to have a more clean impact on our P&L, as we do believe that our management is more keen on having any unknown, unpredictable effects impacting the balance sheet rather than in the P&L. The way we forecast our FX exposure were earlier made once a month by the subsidiaries sending in a forecast. This did, however, mean a lot of double work for the subsidiaries, and it also meant that we had a risk for misalignment between figures. We have therefore changed this process, so now we are using our budgets and estimates for updating our FX exposure, which is possible through all subsidiaries only dealing in the local currency. This implies that we have a one-number policy and that we have an alignment between what the business expects to deliver and what we have in our FX exposure. So now we know the hedging strategy, we know our mandates, we now know how our FX exposure looks like and how we're managing it. Where we really create value from a treasury perspective is then to determine the hedge ratios. And in the old Lundbeck, when we were primarily a European company and had less FX exposure, we still needed to determine the hedge ratio. This was done in a more simplistic way, where we simply divided all currencies into 3 buckets, where the first bucket were not hedged at all. The currencies in the second bucket were hedged at a low rate, and the currencies in the third bucket were hedged at a higher rate. And how we split the currencies into these buckets were primarily made based on the volatility for the currencies. But in line with our FX exposure having increased and the complexity in the company having increased, we have also changed the way that we evaluate our hedge ratios. And the way we are doing it today is a bit more sophisticated, and as I try to illustrate with the second picture, it's based on some more complex calculations. And the way that we today determine our hedge ratios is based on the forward rate, the volatility, and the valuation of the currency. How much each of the parameters impact can be different depending on the structure of the business. It's also possible to add different parameters into the model, such as risk profile or cyclicality. In relation to the first parameter of the forward rate, we believe that this is one of the most commonly used parameters to determine your hedge ratio, as it gives you the expected development of the currency. In regards to the forward rate, we also look at the carry effect, i.e. the difference between the cost of hedging a currency and the interest level in the currency. For the second parameter, the volatility, we look at both the historic volatility and also the expected future volatility. And in general, the higher the volatility is, the higher the hedge ratio should be. For the third parameter, the valuation, we look at different different information in the market, such as bank forecasts or currency flows and other relevant information out there. We then take the 2 first parameters, put them into our model, who then plots each of the currencies into this graph, where you have the carry effect on the y-axis and the volatility on the x-axis, meaning that the more expensive a currency is to hedge in relation to the interest level, the further down in the graph, and the more volatile the currency is, the further out to the right. The third parameter, the valuation, is then taken into account on a more subjective level, together with our own thoughts and knowledge. But in general, the higher up in the right-hand corner, the higher the hedge ratio, and the lower down in the left-hand corner, the lower the hedge ratio. And normally, the currencies that are in the red area is not hedged at all, as it's seen to be too expensive in relation to the risk level. I will then come into 2 practical examples. With an increased FX exposure, we've had several examples of how these have impacted us. I brought 2 of these examples. where I will also show how we from Treasury have created value to the company. And I hope if some of you might have the same challenges that you can get some help from this. The first example is how to manage an exotic currency in a country with currency restrictions. In my case, I've taken Venezuela, as Venezuela is a country where our sales have increased quite rapidly over the past years. However, there are quite some issues doing business in Venezuela, and the main issues that we had implied that it's only possible to make transactions in US dollar, i.e. it's not possible to transfer the local currency out of the country. This naturally implied that we had all our intercompany transactions and all our intercompany balances in US dollar, which created a revaluation risk for the subsidiary, which they had difficulties to manage. When we looked at this case, in Venezuela, it's also very difficult to get approval to be able to transfer funds out of the country at all, and it's also a high risk for devaluation in Venezuela. When we looked at this case, we looked at two separate parts. The first being to reduce or eliminate the local currency risk, but we also looked at doing an evaluation if it still made sense to continue the business in Venezuela given all the risks and issues that we had. So the first thing we did was to contact our commercial colleagues in order to get a better understanding of the business in Venezuela. We then found out that we previously had a director in Venezuela that were a sales guy, which is quite normal. We had, however, recently changed him for a finance guy who was an expert in administrative issues. And this made a lot of difference for us and really helped us. Because now we had a local colleague who knew how to tackle and make changes to the issues we had. And due to this, we were actually able to change the invoice currency from US dollar to the local currency, even though we still had all the transactions in US dollar. We have also been fairly successful in both getting goods into the country, which is a prerequisite to do business, and to get government approval to transfer funds out of Venezuela, which can sound as basic things, but is really difficult if you don't have the local knowledge. We finally made a suggestion to the management to continue the business in Venezuela, as we had solved some of the issues, but still had some risks. And this was finally approved. So we are still continuing doing business in Venezuela. The second example I have is how to manage an FX risk when having an in-house bank set up. And in line with the business being more complicated in Lundbeck, we have created set up an in-house bank structure, which from a cash management perspective is much more efficient. It does, however, also creates a lot of intercompany balances in all different currencies that are reevaluated on a monthly basis, creating an impact to the group P&L. Normally it works in a way that the subsidiaries are generating cash during the year, and which are then distributed in dividend once a year, bringing down the intercompany balance and also reducing the FX risk. It could, however, be that the cash generated in the company is not equivalent to the possible dividend distributions, which would mean that the intercompany balances remains high. And we had such an example or such a case in US, where we were actually not allowed to make any dividend distributions due to our ownership structure. And as our US subsidiary create a lot of cash, our intercompany balances increased, which then were to be reevaluated. And as the US dollar strengthened quite rapidly, in the beginning of this year, we were facing a big negative revaluation risk or revaluation impact. And in cases like these, it's important to be friends with your auditor, and I am lucky to sit next to a guy from PwC. And We had some lengthy discussions with our auditor and came up with a solution to our issue, which were in compliance with IFRS, which meant that we created an excess cash account. And this excess cash account were still part of the in-house bank, but from an accounting perspective, it was seen as part of the net investment in the subsidiary. And as it was part of the net investment, it will be reevaluated over the other comprehensive income, i.e. in the balance sheet rather than in the P&L. And at least our CFO was much happier having an unknown FX risk impacting the balance sheet rather than in the P&L, especially as it's significantly negative. I hope it was possible to follow the logic in these two cases. Otherwise, please get hold of me during one of the breaks and we can discuss further. That's all I had.